Alrighty, good morning everyone. So I'm gonna actually let them introduce themselves. It's gonna be more fun anyways. So please give a round of applause for my rock star panel. We're gonna talk about macro cryptoeconomics. Welcome up my three fantastic panelists. That's actually pretty good. You're already awake. So usually well, our heads are no longer there, so sit wherever you would like, guys. So usually I have to ask a couple times to get you excited because that was a really good welcome, so good. But I'm still going to ask you to do it again because I love it when the audience gives them energy for us to start our conversation. So how are you guys doing this morning? Good? Oh, no, see, that was less. That's shit. Okay, let's do that again. How are you guys doing this morning? Good? Because we are going to just have a fun time talking about macro cryptoeconomics, and this is going to be if you're not asleep yet, you will be soon. No, this is going to be a fantastic discussion. If you have no idea what that even means, macro cryptoeconomics, we're going to work on that as well. So instead of introducing them, I always like to let panelists kind of introduce themselves because it gives context and lets them kind of say it better than I probably would. So I will turn it over to Lex to say who he is, what he does, and we'll go from there.
Fantastic, thank you. And thank you for having us. I want to get just a sense of the audience. How many people are from the kind of media, creative arts side of the equation, the NFT side? Okay, it's like 5%. There was a person who raised their hand, got embarrassed, and lowered their hand. So maybe it's 6%. And then how many people are from closer to finance, financial services, trading, that kind of stuff?
Oh, look at that.
Yeah, look at you. How's that going? No? That's raw. That's still raw for people. It's okay, I've lost money too. Okay. That's not funny, whoever's laughing over there. I can see you. Okay, so my name's Lex. I am a managing partner of a venture fund, early stage venture fund called Generative Ventures. We focus on fintech, Web3, and some AI themes as well. Before that, I was the chief economist at Consensus, where I ran the Cryptoeconomics team, and I looked at token engineering, at DAO governance, treasury management. So I'm super excited for the topic today. And learning more about you. Who are you people?
There we go. Yaroslav?
Yeah, there we are. Well, nice to see you. Hi, everyone. Thank you for coming. Can you hear me? Yes? We're good. So I'm a partner of Faculty Group. Faculty, we build, we invest, we advise companies. Essentially, we're a VC firm with market making, venture building, Web 2 to Web 3 capabilities around that. So we started back in 2018 very much as a humble market maker and grew to 6 companies under one umbrella. So it's quite broad, it's always fun to explain, but we cover everything from economics to market making, business building, so kind of seen the good, the bad and the ugly in the space and kind of been through the wars. So excited to share some thoughts.
And Mo.
Excellent. Good morning everyone. Oh, testing, can you guys hear me? No?
Yeah.
Oh yeah, okay. There we go. Thank you.
Please give a round of applause for the guys who don't get to get on stage but make it all work, our fantastic tech guys back here. Please give them a huge round of They make this thing all work for us. No, all to you.
Excellent. Let's go. GM. No, let's try the next mic. GM. No mics are working. So I guess I'll just have to project my voice. Can you guys hear me at the back?
No.
Yes, okay. Oh,
there
it's
we are.
working now. We got there eventually. Thank you everyone for your patience. So I'm Mohamed Ezeldin. I'm the head of Tokenomics at Animoca Brands. And really the vision that Animoca Brands has is all around digital ownership. Being able to have freedom around your choices, ownership of your data. We were a games company in 2017, pivoted by launching a VC firm and really started investing within the space. Yeah, our leaders saw the vision of what NFTs can potentially bring to the space. And I think 5-6 years on, we're really starting to see the beginning of that. Our portfolio is over 450 companies strong with nearly 20 subsidiaries. And really it's about the blue ocean mentality, how we can grow the pie together and really give ownership back in the hands of end users, migrating them to be members of the community.
Brilliant. So we've got 3 very different perspectives, I think, kind of they cross a little bit, but they also have their own spaces. So that's why we're going to have a fun conversation about a bunch of different topics. But to start with, I thought I would throw out a definition of what macro cryptoeconomics could mean. Obviously, depending on your perspective, it can be different too, but just because I think that some of you might be going, I have no idea what this panel is supposed to be talking about, so let's have that conversation. The description I found, well, actually asked ChatGPT, so this may just be completely made up, but lovely ChatGPT told me macro cryptoeconomics refers to the study and analysis of the economic systems and structures that govern the functioning and value proposition of cryptocurrencies and blockchain networks. It encompasses the evaluation of economic incentives, governance models, monetary policies, and overall economic principles that make decentralized digital assets function. So all that fun stuff, governance, monetary policy, network security, market dynamics, token economics, network effects, and the whole regulatory environment, which means we can talk about a lot of stuff, but we're not going to touch all that because we don't have that much time to do that. But I thought, in light of a very broad topic, for each of you, what do you focus on, or might, at least maybe if we talk about the state of crypto right now, what are you focusing on, or what part of this subject interests you the most right now? And that will let us kind of open that up and go down each of these rabbit holes depending on those different points. I've got a whole bunch of questions for you, but I'm also interested to see how this subject speaks to you already. Who would love to jump in on that very open-ended, any thoughts? Well, you mentioned a whole lot of tokenomic stuff or things like that. What would you see?
So, what a rabbit hole. It's what I appreciate about the moderation is the bounding of the question up front.
Which means I did a terrible job.
I'm kidding. It's my fault. Okay, so I think it's actually, there's economics and then macro and micro, and I think ChatGPT might have hallucinated a little bit because there is let's say within economics there's the split between macro and micro. On a macro scale, you're looking at economies top down. So you're saying what's the money supply, what's the productivity of this economy, what's the GDP, what are the sort of systemic things that are driving activity. Often you can just think about it like, what's the economy doing? And then on the micro scale, microeconomics is really the study of bottoms up. So you're studying human behavior, indifference curves, incentives, the theory of the firm, the trade-offs that firms make in production, hiring, and so on. And so things like token engineering and token incentives often are about, the behaviors of agents. What will agents do within some particular set of incentives that you give them? So for example, if you're a DeFi protocol and you're like, hey, we're going to give people fake money to wash trade, people are going to wash trade. That's microeconomics. That's not funny to anybody. That's really serious. Nobody's ever wash traded on a DeFi protocol to get fake tokens. Still not funny. It's only funny to you because you know what?
We're laughing with you, not at you.
Because you know what? Market making. Okay, so the other side is, the macro side, and the macro side is actually very connected into all the traditional macro factors because they're consequent. So for you to understand, like, why are people moving money on and off exchanges, or why are Bitcoin prices or ETH prices moving in some particular way, you have to understand not just the economic factors for ETH staking and what % of people are staking, and like what are the interest rates within ETH versus some other staking protocol, and then is that real or nominal, right? Like those types of things within our industry. But you also have to go back and understand the overall macroeconomic environment, right? So what do interest rates do to GDP, to employment? What is the risk-on, risk-off trade-off for large investors? What does it mean for BlackRock to rebalance? What does that mean for hedge funds and venture funds? What does that mean for companies raising? What does that mean for people liquidating out of DeFi into cash? And what are all these flows? How are they connected? So I wanted to kind of just draw that separation between macro and micro. And I've certainly taken up more than my share of time. I'd say that for me...
And we're done. Thank you for coming. That was really great to have you here with us today.
Just to tie the bow, for me, the interesting part is really that question of, in Web3, we understand we have these tools. We can play with incentives in ways you can't in traditional startup land. We can play with macro incentives at the level of an entire project economy. But for all of that, there has to be a real GDP being generated inside of Web3. So I'm obsessed with the question of where will labor productivity in Web3 come from? Real assets, on-chain productivity in DAOs, generative AI and labor, digital labor coming into the space. So for me, it's that sort of what's the wheel that turns the whole thing.
Yeah. Let me try and take this from a. Can you guys hear me?
Yes.
Let me take this maybe from a builder perspective more. And I guess there's I think the simplest way to think about, again, such a big topic, but what are tokens? It's programmable money. And as Lex touched on, it's ability to imbue certain properties, traits, behavioral kind of incentives and punishments into tokens, whether they're NFTs, whether they're fungibles, whatever they might be. And the space of token economics is, as I always say, is really broken into two areas. So you have the token mechanism and the mechanism design, the value accrual systems, and then there's the distribution. So kind of how you get the token into people's hands. And when you think about token kind of mechanisms, if you will, this is the part that is often done really poorly from what we've seen, which is a case of, hey, I want to launch a token. We're going to figure out what it does later. It's kind of putting like the cart before the horse. So you start with the question of, what is my token designed to do? What is it supposed to be doing? What do I want it to be doing? Do I need a token in the first place, or is it just something that is a fundraising mechanism or something of that ilk? And you're looking at, again, who are your stakeholders in the ecosystem? What are the value flows between the stakeholders? How do they interact? Does this make logical sense, economic sense, legal sense? In the sense, are you making a security by accident and you don't know about it? And the second part is distribution part, which is how do you get this token into people's hands? So early days, we saw, the ICOs of 2017-18. Then we saw liquidity mining, back in sort of DeFi summer 2020, where we are minting free tokens off the back of a lot of wash trading, as someone alluded to.
I don't know why you're looking at me. I didn't do it.
And there's that part, and there's also, we've seen airdrops, so retrospective airdrops on people. Who are the people using the system? So it's all around how do we get these tokens into the right people's hands, who are fundamentally going to be using our protocol. And so distribution is a whole separate topic, but again, just to kind of summarize that. Value accrual versus distribution, and that's the world of token econ. I think too many people focus too much on distribution and the metrics versus the actual values that actually tie it back into the business model.
Thanks, Yaroslav.
Not much left to say, but again, a quick touch on Bitcoin and Ethereum. The combined power between both is approximately 60% of the total market cap within crypto. So we really haven't seen any other tokens break anywhere close to that range as of now. And a lot of the points were alluded to earlier on. So I think we're still quite early from that aspect. And fundamentally, the movements that Bitcoin and Ethereum make do have a big impact on the rest of the tokens or the price action within the space. Probably keep it short so we can discuss something a bit more sexy later on.
No, that's great. That gives us, again, 3 viewpoints, but tons of subjects for us to dive into. And for context, because also why am I here? So I live in Paris. I'm excited to come and meet a lot of you because the London ecosystem is really fantastic, but a little, not insular, but we don't hear necessarily about everything going on here if we're not here. So I'm as excited to come and get to meet a lot of the people I didn't know. A lot of amazing stuff is going on the continent when it comes to Web3 and everything around crypto. And so with Borderless, I create syndicated investments, grouped investments into Web3 and AI. I'm one of the co-founders of the NFT Factory in Paris, which was founded by 128 people from like Ledger and Sorare and the Sandbox and Artifact and Ariani and things like that to build a physical hub for the Web3 ecosystem in Paris. It's also because it's a hub, it's because it's physical, it's also now the world's largest digital art gallery. It's 400 square meters and 70 screens. So if you happen to be in Paris, come check that out. It's a really cool place on the digital art side, but also really the hub of a very vibrant and dynamic ecosystem. So what I'd love to then maybe go from there is, if we talk about the state of so you each kind of went into some of what the topics could be. Let's maybe talk about the state of where we're at right now, just in terms of crypto, because I think that's important to maybe the idea of the bear market and bull market, and right now we're in a place where everything just seems to be kind of, so why what do you think are the major factors right now keeping us from kind of getting out of this market that we've kind of been in for a while? And how do you think we can move forward? And then we'll maybe go down into some of the specific topics you brought up that way.
So I think for me, fundamentally, it's a lack of product in the space as of now. From where we were a few years back, the technology or the back end, so to speak, has come a long way. We've saturated the amount of people coming in for the decentralization, the digital ownership. The fact of the matter is everyone in Web 2 don't really care about ownership. And we'll just do a quick experiment together now. How many of us remember a few years back when Facebook or Meta bought out WhatsApp? And we were all thinking, oh shit, they're going to have access to our data. How many of us downloaded a Telegram or a Signal at that time? Quick show of hands. Okay, maybe 10%. How many of us are still using WhatsApp? And that's exactly the point. Yeah, we know our data isn't safe. We don't have ownership of that, but we continue to use because of the network effects around everyone within our networks are still using WhatsApp. We haven't really seen that migration to Signal or to Telegram to really force us to move as maybe we did when BlackBerry Messenger, for those who are old enough in the room to remember that, to migrate to WhatsApp. So I think that's one of the challenges we currently have within the space right now. The scammers in the space, crypto is not a scam, but because of the lack of regulation around crypto, people have taken advantage of that. And we saw with the Creator League as well, with the mention of NFTs, for example, and blockchain in the back end, there was a big ruckus from a lot of the creators, and that ended up falling apart. So we still have a way to go from having tangible products that abstract away the blockchain. We're getting a lot closer with things like account abstraction. I think in most instances, outside of DeFi and maybe DAOs, we don't need a token-first approach. Have a product there, have critical mass, and critical mass does vary from product or platform to platform. And then once we start to really have tangible data, then we can look at introducing the right kind of fungible token. But you can see the ecosystem with different forms of NFTs to really engage people and have the community buying in.
Yeah. Thanks, Mel. Yes?
I'll add to that. I mean, I think right now we've got enough infrastructure, we've got enough block space. We need to fill it with apps actually using that block space. So getting more genuine traffic, not some mercenary capital who's there to farm the latest airdrop, but people genuinely willing to stick with the app because it gives them value. The blockchain abstraction, again, I always use the analogy. If you want to drive a car, you don't need to know how the internal combustion engine works. You don't need to know which layer you're building on as an end user. If you're building on an on-chain, I don't know, Candy Crush is probably a bad example. So that's the first piece. So it's building apps that generally have user throughput and users actually using this, not for the financial element, but because it makes sense and they enjoy it. That's the first piece. I think the second piece, we still have far too many tokens that just shouldn't exist. Back to your point. I mean, let's start with building companies that solve problems, finding us problem solution sets that are commercially viable, were wrapped in a commercially viable business model. And I'd love to see so much more equity raises with token warrants built in and issuing a token if it makes sense. Token makes sense when there's a whole plethora of pieces. If you're more D2C, there's a whole piece around content, contact, commerce. We have this kind of 3-piece rule where you can centralize that, and there's a whole piece around how you could do that. Let's say doing on-chain loyalty programs. Sure, you can do that. You can do, again, you're trying to decentralize over time. You're going to start decentralized. That's natural for a startup. Don't decentralize too soon. It's going to go horribly wrong. Who here is part of a DAO? Just raise of hands. Okay. Who here has seen the level of traction or engagement in DAOs and seen it as a problem to actually getting stuff done? It is a pain. It is an absolute pain, right? So let's not decentralize too quickly. So I'd love the space to go back to lean startup principles, solve problems people care about, and then build in these Web3 mechanisms off the back of product market fit, rather than trying to do it the other way around. I'll pause there.
Great. Lex?
I deeply agree with all of that, except one bit. But I would use different. I've come to use different framing for it. So the bit that I would disagree with is not having a token, and I think that stems. There's two separate points. One point is a lot of the participants, and like if you're in the fog and you're trying to explore the forest of possibilities and you don't know what's coming next, right? So the algorithm that gets you through uncertainty best is called novelty search. So it's not like you have a linear path from here to there. It's like, I need to make 100 million in revenue, so I'm going to make 1 million and then 5 and then 20 and then 50 and then 100, and that's my plan for the next 10 years, and I'm going to do that because that's how things work. You can't linearly plan through uncertainty. So the algorithm that gets you through that, or that gets on average somebody through that, is called novelty search, where you find the thing that is most outside the bounds, that is the most weird, and you go there, and then you kind of island hop until you get to the other side. The thing about novelty search and going through the fog is that 99.5% of the novelty searchers die because they, it's not a stepping stone, it's a crocodile mouth. So it's tricky, and you do have to get through it. And I think where we are now, there's industry level deep confusion, and I'm in the industry and I have this confusion as well, but a profound confusion as to like, what is a Web3 business? Like, nobody here, including us, actually knows. It's not a laundromat with token ownership of like laundry slots, and it's also, it's not like, no offense to anybody who's doing this, but it's not necessarily, it's like not metaverse rent plots for non-existing demand. It's not, it's not yet beautiful 3D fashion, no matter how cool that is. And it's not the financial games of Olympus DAO or Terra Luna. We know those things are not it, like we've explored them. So we don't really yet know what the economic loop looks like. And so my language for it is less kind of like Web 2 lean startup first principles and more of like just, what is the GDP of the space? What does that look like? And if you boil that down even more, it's, where does GDP or economic growth come from? And the answer is, well, like, I make a thing that cost me less than it is valuable to you, then we exchange it and you're willing to pay me something because you're getting consumer surplus and I'm getting producer surplus. And then we have a transaction and we're both better off. And that's kind of the core glue at the atomic level of an economy. And so what is that for Web3? And I'm not sure yet, and I think more discovery is necessary to figure out that economic loop. But the second part of what I started with, which is like, actually, I think it's more likely that we do need more tokens, like billions more tokens. I want like every 5-year-old in school to issue securities every single day. Like, I want that. I want it to annihilate the regulatory landscape. So it's practically impossible to reason about regulating ownership and participation. Like, to me, that's the extreme where we have to be at, where like literally it's complete nonsense to talk about. I can't hold a token because it might give me revenue. I mean, that's like psychopathy. It's totally destructive to actual innovation, right? I'm a book publisher and I don't want people to have, oh my goodness, like a child will send emails to other children and there will be dozens of those that they send every day, or like they're gonna text people like 100 times a day. What a crazy world. Like we should read their text before they publish them because we gotta control what people read and think. Like of course you don't ask the book publisher. You can't. And so similarly, I think like the industry, end of the day, has to break this idea that ownership is securities, and it has to break the idea that like revenue sharing is a wholly enshrined church of capital markets that only like Delaware corporations can do. No, like all of us should be able to issue millions of tokens a year that give you different participation, different stuff that we do. And I think that's the core value prop of Web3. But because that's not available to us yet, and because it's in the fog, I think a lot of us are kind of falling back on like, okay, well, what's worked in Web 2? What are the economic loops there? And then what rules do we have for things that look like it? And so until we process that, which might take quite a long time, it's going to be tough going.
Can I just add to that? Experimentation is good, right? Just don't hear me wrong here, because I was at Friendtech recently. If you guys are following, some of these experiments are awesome. Some of these companies may not survive. We don't know. No, I don't know. No one here knows whether Friendtech will be around in 5 years' time. We'll see. Maybe it's the Netscape. Maybe it's the next Amazon or Google. These experimentations are great because we get to see what works and what doesn't. Just as we saw in 2017, payment tokens perhaps weren't the best way to do things, right? We had the V models, we had all these different models, and the only way we figure out how to move forward is by screwing up, really, and trying things. I guess the key message I wanted to kind of get across is, if you are doing an experiment with some kind of token, Web3 kind of token economy, having a very clear value proposition of what it is you're trying to achieve first, and then launching the token, rather than launching the token, raising into that token, and then thinking about, well, what do I do with it after? And I think that's kind of the key message there.
Yeah, that's a great, and I do think that's really important to highlight, especially where there's a lot of builders and entrepreneurs or wanting to be entrepreneurs in this space. These kind of conferences attract a lot of people who are obviously already doing it, but also want to. And one of the things we still see a little bit too much is people just being like, oh, I'm doing something, we're going to do a token. And I agree, we can have more tokens, but they still need to do something, like in the sense of there needs to be a reason, even if in the end we decide that it's still experimentation. But if you're starting a company and you need to raise money, it might make a lot more sense to raise it so that people have an interest in what you're building on the equity side. If there's a reason with the token warrants, whatever, that you throw tokens into it, great. But it seems like people are just making up tokens to make them up because they feel like they're supposed to. I think Lex wants us to do that, so that's a different opinion that we can keep going down that road. But I do think so regardless, actually, between the two views, I think the important thing is to just take a step back and say, ask the question. Should we do this? And if we err on the side of, well, let's do it because we want to experiment, we have some ideas. Cool. But if we also come to the side of it of, well, we don't really have a reason to do this, we just think we were supposed to do a token, I would argue that's probably not a good idea. But the experimentation piece, I think, is really interesting in that. So I don't want to, I think you're probably saying similar things, but I think it's the issue of doing it without any real reflection on the idea of why are we tokenizing stuff.
Let me, from an investment perspective, I'm 100% aligned with you. Like, both the token warrant and the exposure and the smart design of tokenomics, and especially if you have a project that's working, you don't want to blow it up with like early liquidity and all this stuff, so 100%. I'm making kind of a qualitatively different point, not to undermine the like what's an investable company and investable project and good token performance and capital appreciation and high quality compliance and a lack of market manipulation, which are all wonderful things and should be enforced and regulated. I'm making a different point, which is nobody says, does that, you made a website, does that website need to exist? Why'd you make that pointless website? Or is that tweet valuable? Have you, like, is
we
that
should ask that question more often, maybe.
Well, but of whom? Who gets to decide?
No,
the answer is nobody
that's very
gets
fair.
to decide.
Yes.
So the core principle is absolutely not. You don't ask, should this website exist? It's not helpful. Or should this tweet exist? This blog sucks. Why? Don't. There's the tokenized asset. For me, that's the invention. That's the building block. In the way that a hyperlink is for media, a token is for stuff that you can own. So absolutely, yes, go make total nonsense tokens. And you shouldn't be persecuted for it, and you shouldn't have the pressure that they have to be some holy thing that represents like all of corporate law.
I think the issue right now is that I love your vision of where that could be, but the problem is right now is if a startup wants to raise money and they throw a token at it and they try and call it utility and it just really isn't. The reality we live in still does have implications other things being securities. So we want to break that.
You're trapped in the capital markets, okay? User-generated finance. This is the mental model. Would YouTube work if every single person who uploaded a video to YouTube had to ask, is this going to be funded by the motion picture studios and be made into Harry Potter? And the answer is obviously not. The answer is yes, you still upload your crappy YouTube video out of, because you feel like it, you're driven to create. And I think that people have a drive to create media assets, economic assets, and so on. And so I totally give it to you in terms of the capital markets framework. If you're trying to raise money, yeah, build the motion picture, build the security. But is that the right answer for all the builders here? Like, I don't think so.
No, definitely not. I think just to wrap up that piece is just the idea of some of the things, even if people aren't raising capital, some of those things are still going to fall into this shitty place of it's still a security, even if that wasn't what the point was. And so I'm just to ask yourself the question of, let's play with this. Let's tokenize absolutely everything. But you, at the end of the day, you may have to have some serious discussions with your regulator because you cross some lines. It'd be great if we break that. But let's talk about the regulation side maybe a little bit, or also the institutional side, because I think we talked about you as builders wanting to build things. But maybe part of this macro conversation that's really interesting is the institutional adoption. How do you feel that affects where we're at right now and where we're going in terms of this larger economics idea of where crypto is at? Because we see so many big companies, big investors, large corporates all acquiring crypto or trying to play with crypto in some way or whatever. What are your thoughts about how that's affecting where we're at, and can that be the reason this gets better because we get all this more institutional adoption? Or not?
Do we really want to talk about regulation?
But we can. We've got 5 minutes, so.
I'll just link it back to something earlier on, and it's, for me, there's a big challenge in the space between motivation and incentivization, and I think it's something that's not spoken about enough. And I think it's to Lex's point, and actually the discussion we were having, that a lot of people who want to raise on a token, there's an incentive there for them to do so because it's a different way to be able to raise funds. But then for a lot of users coming in, or community members coming in, unfortunately what we've seen in the space is they're coming in because I buy a token at X and I want to cash out at 10X, as opposed to I'm motivated to come into this ecosystem to add value, where we can then really grow whatever that value proposition is together within the community. There's a lot of speculators, they go by a lot of other names, maybe I won't say on the mic right now, but we have a big issue there. And that's sort of, there's a dark cloud over the space because of the number of bad actors. So when we talk about regulation and some of the maybe larger companies looking in, they have to act within certain parameters because of either they're listed, for example, or the different frameworks that they have to abide by. So it becomes very challenging to come into a landscape where the majority of the users in the space are not actually looking to participate in any way to add any meaningful value. And I know that's a big assumption to make, but it's an assumption we can make just based on the data that we've seen. And there's very few people genuinely looking to add value. So when the larger corporations look in, it's just, okay, we can launch something, but does a token make sense for them is an entirely different question. But fundamentally, can they leverage the tech to be able to start to solve some problems and maybe derive new forms of business streams and revenue? Then yes, there is, and I think we are slowly getting closer to that. The XRP ruling a couple of months ago has been, I think, a bright light in the space. I know loads of different companies are now looking at that and being like, okay, now we have a good chance to actually launch a token because the narrative is there and there is a window. But then again, these are companies as opposed to individuals who are just like, I'm motivated to create a token like Shiba Inu or Floki, like some of the meme tokens that we've seen, who really have no utility. But at the height of the market, we had, what, 2 meme tokens in the top 10, if I recall correctly, and no buzzwords, no utilities. We can look at NFTs as well. When the NFT buzz came out, like, I got it wrong. I generally thought in-game assets would be the big thing in NFTs, and it was PFPs, purely because of the simplicity around it. But I can associate who's in a similar community or in the same community to mine because we both hold the same type of NFT. If it's an ape or a cat or a dog or some randomly generated piece of 3D art, it became very easy to associate who's in the same community with me, and there was that level of trust that was there that probably didn't exist before.
Yeah, there's a real kind of there's a couple elements to that, right? The really interesting experiment with NFTs that we've seen is that it's what you saw with peer-to-peer lending back in the day, the crowd cubes of this world, where I will invest £1,000, whatever, into a project I'm genuinely excited about with no real expectation of financial gain from this. Maybe there'll be something, but the reality is because I'm really passionate about it and I want to be part of the club that was the early adopter of this underground thing because I was in there first. And you really see this through and through in crypto. Like, why are you buying this? Yes, maybe it's for the financial gain, but a lot of it is to be part of that kind of support piece. And that's what you see with a lot of these NFT communities. I think on the institutional side, going back to your point, a lot of companies are already experimenting with this right now. The reason why the SEC and Gary Gensler is, kind of gone the other end of the spectrum, and he wants, everything is security, tokenizing baseball cards and Pokemon cards will be security at this rate, is because there has been so much, so many bad actors, or let's say failed experiments that, started in bad faith in the beginning. But I think there's so much good stuff happening as well, like on-chain loyalty. A lot of the big companies are experimenting with this right now. How do you engage with as a brand or an entertainer? We saw it with Messi, for instance. Messi, Ronaldo. Instead of going to taking over $1 billion contract in Saudi Arabia, he went to play for a US team where he retains some of the rights because he recognizes that people follow Messi for Messi, not for the team that he plays. So how do I get this direct-to-consumer, direct engagement with my audience? Secondly, what are the levers I have to engage? How do I give away my data to all the intermediaries in the middle, or is there ways to build fan clubs around engagement, around tools? How do I build incremental revenue streams? And again, a good example is if you go on Amazon and you'll buy, you buy something, instead of the call to action to buy, imagine there's a button saying join the community of others who bought the same. And you come into that community. If let's say you bought, I don't know, a Russell Hobbs kettle or something, and everyone else bought it, but they might be talking about a great toast they bought as well. There's a higher propensity to buy. So things like this unlock hyper-targeting towards your user base, hyper-engagement, new revenue streams, new channels, new ways to give them, collectibles, reward them with POAPs for coming to events. So yes, minting tokens, etc., but it's kind of rewarding for that behavior. So I think institutions are playing with this, but they're playing with it much more, less from a financial perspective, but more from a marketing in terms of increasing customer stickiness, creating more LTV and reducing kind of CAC for some of these users.
Brilliant. I would love to give you a chance to add on to that, but we are out of time. So I think what I will just say is if you want to have a chat with any of these guys, they're hanging out, they're here at the event. So please give them a huge round of applause for contributing to our discussion.